My account has blown up in profit after mastering liquidity in the market. I will show you exactly how I went from being the liquidity to using it to my advantage. First, do you even know what liquidity is? If you can't answer this question, you are most likely an unprofitable trader. This might be you, but just 6 months ago, I was taking L's left and right. I was straight up gambling, with price hitting my stop loss over and over again. After this video, it will be almost impossible for you to make the same mistakes. Now, what is liquidity in the market? To put it in simple terms, it's basically a pool of money sitting in different areas of the market. What people don't realize is that these pools of money are where institutions, banks, and hedge funds take the majority of people's money right out of their account. And no, they aren't risking a measly $100 per trade. They will have orders ready to be executed for millions of dollars in just a single trade. These big investors sweep the market at these money pools, making the price move up and down with high volatility. This is called a liquidity sweep, and it is very important you understand this concept, because we will use it to our advantage to capture these high volatility moves. In order for a liquidity sweep to happen, these institutions manipulate the market and push price to where they have their buy and sell orders. So in order for these large orders to be filled, they need amateur traders to liquidate their position so that they have enough buying and selling power for their orders to be filled. They always want to get the best price, so they induce liquidity. That's why when you enter the trade, you get filled almost immediately and the market doesn't even move. When these institutions are placing their trades, they need to have enough liquidity to place their large order. That's how they manipulate the market and catch their victims, causing candles just like this. They also want people trading in the opposite direction that they want to go, which makes people exit their position on a loss while the institutions use that fresh liquidity to place their orders. Now that we understand liquidity sweeps, we need to find where these amateur traders are exiting the market and where they are entering the market in the opposite direction that these banks and institutions are wanting to move. In order to find liquidity, we'll go on a higher time frame like the daily chart. What we're looking for are trends going up or down. Right here, we have a big trend heading upwards. If we look closer and analyze the structure, we can see the price making higher highs here and lower lows here. The start of a liquidity sweep happens when there's a break of structure in the trend, meaning the lower low of the uptrend is broken, just like this. At this moment, people see this break of structure and are thinking that the market is going to reverse. So they place their sell order with their stop loss usually at or above the lower high that was formed. The thought process of these uneducated traders is that if price were to break above the high, it will go back up and continue the uptrend. So now, when we let the market play out, it will go and hunt the stop losses. All the sellers are probably punching their monitors right now. Once this happens, people are now going to want to buy into the market, hoping it will continue upwards since it broke structure and made a new high. At this point, we have people selling off orders and other people buying orders in the opposite direction. This is exactly what the institutions want to happen so that they can get their orders filled with all this floating liquidity. If we let the market play out, we can see the liquidity sweep happen with a big push down, taking out the people that bought into the fake uptrend. Again, punchy monitors. Believe it or not, this happens all the time in trading. Think about it. How many times have you placed an order thinking it was going to reverse, only to get stomped out right at your stop loss and then immediately switched in the direction that you initially thought it was going to go? I've been in this situation just like the majority of new traders, and it was not very fun. Not only does this happen in an uptrend, but it can also happen in a downtrend. Now, the first thing to look for is the trend making lower highs and lower lows to be considered a downtrend. Second, we need to see a break of structure here, which will cause people to buy in with their stop losses here. After that, we will let the market hunt the stop losses, which triggers a big push down. Now, sellers are going to see this break of structure here, making the bet that the market is going to continue downwards. But as we all should know by now, this is a big liquidity sweep, causing price to reverse all the way back up. But even with all this new knowledge I just dropped on you, where should you get into the trade? The answer is simple. Sit on your hands the whole way through the liquidity sweep and do not enter the trade after this pattern, like some FOMO gambling addict on a slot machine. What you need to see next will be a confirmation that the trend will go in your favor. Wait for another break of structure right where the fake trend is broken, and have your stop loss right below the liquidity sweep. Remember to be patient and take profit where price might reverse. I have a whole video that goes more in depth about reversals that you need to look out for, which I will leave in the description of this video and on the screen here. Remember to smash that like button and subscribe for more content just like this. See you later.